Good afternoon, traders and investors. Will back here with another one. Hope everybody's doing well. Going to give you guys a Wednesday market recap. And in today's markets, guys, most of everything moved higher on the day. SPY up 0.83%, QQQ up 1% on the day, and financials and healthcare holding their own. The loss leader on the day was your IWM Russell, once again, as growth stocks continue to struggle with the repricing of Federal Reserve rate cuts for March and potentially for May as well. So in today's video, guys, we're going to do a recap of 4 earnings that I have for you guys. We're going to tackle Alibaba, PayPal, Disney, and Uber. 3 of those companies have been struggling recovery stories in the names of Baba, PayPal, Disney, but one of them is performing extremely well and has now achieved profitability for a full year, which has never happened in the company's history, in the name of Uber. So very curious to take a look at those and how those have impacted the earnings statements for today and the price action as well. So we're going to be going over those, guys, and as usual, if ever you want to skip to a certain part of the video, keep in mind I do always leave the timestamps down below. So if you want to go over one or more of the earnings calls, just check out the timestamps below. In today's video, we're also going to be recapping your major indexes as a whole and our major tech stocks, see how everything is shaping up as the rally does continue. Now, on a one-day relative performance, guys, you'll see that it was a fairly top-heavy market once again, with your outperformers once again being big tech. Financials did have a fairly decent day as well, though. On the 1 month relative, however, it paints a slightly more bleak picture, as you can see how top heavy these markets have now become. Most of big tech has been your outsized gains for the past month and a half, and it has led markets to be a little bit extended, which is why I do reiterate, guys, that if you do have swing trade positions that are up a considerable amount since the month of November, it may just be a very good opportunity to take some profits off the table and potentially write some covered calls, as well as markets start to get a little bit overbought, and as the market breadth, meaning the participation of the number of S&P 500 components that keep going up, is getting reduced more and more and more. So the market breadth is thinning out. So just keep that in mind. I am still of the opinion that even though the bulls are in short-term control of these markets, it is potentially time for a temporary top for the market to be set, and heading into late February seasonality, which is known to be quite negative, and into March as well, that may just be a time where the markets will pull back. But so far, the bulls still remain in control. So before we get into our technical analysis of our major indexes here, let us go over some of your earnings plays for the day. And we're going to start it off with a bang here, PayPal. So PayPal, how did they perform after earnings? Well, unfortunately, guys, it was a disappointment. They actually had a double beat, but missed on guidance. So you can see here, nice little beat on EPS for the quarter, about 8.5% to the upside, beat on revenue for the quarter as well, but unfortunately their guidance for 2024 was a bit lackluster. They did pull back EPS guidance as well, so that's definitely going to hurt the company in terms of their earnings per share and in terms of their valuation multiples. Even though the company is cheap right now, it definitely doesn't help when management pulls back on your EPS expectations. So in the after hours, PayPal dropping about 8.5% off of that weekend guidance despite your earnings beat. So let's take a look at exactly how they did, and we'll go through a bit of their financial statements to see if the company is still stable. PayPal issues disappointing guidance even as fourth quarter earnings top estimates, as we just reiterated previously. So, PayPal provided guidance for the full year and first quarter that fell just short of expectations. The company anticipates full year earnings of $5.10 per share, below the $5.48 analysts expected. So at an 7-8% pullback here on the expectations for EPS for the full year pretty much of 2024. For the first quarter, PayPal estimated year-over-year earnings per share growth would fall in the mid-single digits compared with a consensus estimate of 8.7%. So for the first quarter, the guidance was mostly in line, but they have been pulling back on the year as a whole. Finance chief Jamie Miller said on the earnings call that the company will stop providing annual guidance and instead just provide an outlook for the current quarter. Given the considerable changes underway at the company, we believe it is prudent to guide revenue one quarter ahead and provide updates as the year progresses. So since they're going through so many changes, guys, in terms of laying off employees, cutting back on costs, and improving different segments of the business, that is why they're potentially cutting back on the guidance for the full year. Understandable. PayPal is going through a number of changes, which is the same for pretty much a couple of the other companies we're going to view today in terms of Alibaba and Disney stock too. Now, PayPal announced last week that it would cut 9% of its global workforce, or about 2,500 jobs. Last month, the company introduced new artificial intelligence features, the first major announcements under CEO Alex Christ, who called it the start of the company's next chapter. Now, he did also say that they were going to shock the world, and unfortunately, it has been an underwhelming shock, to say the least. I do like the new features PayPal has rolled out, just continues to be a bit of a blur as to how they're going to translate to bottom line and free cash flow improvement. We're driving significant transformation across our company and are committed to making the necessary changes to our business to drive profitable growth in the years ahead. Now, this is very good, guys. The one thing is at least PayPal's management now has very good heads on their shoulders. They are currently in the process of reducing costs and improving operating efficiency, which is exactly what Wall Street wants to see. But 2024 could be once again a bit of a transition year for PayPal. But all is not so bad, guys. The business is growing. However, it is not growing as fast as it once was. And that is evident when you take a look here, guys, at their revenue in terms of your past revenue and past EPS. You can see really big bump here during the pandemic years of 2020, 2021. And ever since then, it's remained roughly flat. Now, we do have a potential increase coming into 25 and 26, but for the most part, guys, going to be fairly flat even for 2024 here, should be revised ever so slightly down from your current estimate. So should be another flat year for PayPal. And revenue as well, guys. Revenue, although has been increasing at about an under 10% rate, for the most part, you really want to see an exponential expansion starting to happen. And that unfortunately hasn't been guided so far. Only revenue still expanding at about 7-8% a year, a little bit slow in my personal opinion. Now, take a look at their CEO observations here. Going to reiterate exactly what they're going to do in 2024. PayPal has a powerful position to build upon, strong franchise, brand trust, and employee culture. Yes, it's one of the most known brands in the world. Engaged global two-sided network at scale. Yes. Now, priorities for driving focused execution in 2024. Accelerate our branded checkout business. Number one, improve overall profitability, including higher growth PSP services. So we need that increase in profitability. And then unlock the power of data to create more value for our customers while tapping into new sources of revenue and margin. Operate more efficiently. So you see the main bullet points that they're going for here really revolves around operating efficiency and just recapturing some of those growth metrics that have been dwindling over the past few years for the company. But all is not so bad, guys. The total payment volume in terms of PayPal has been going up. So revenue has been up in terms of Q4 over Q4 basis 2022, up 9%. Now, total payment volume as a whole for the fiscal year 2023, wrapping up the end of the year-over-year growth, total payment volume up 13%. That's very good. Year-over-year growth for the full year, also 8%. That's fairly good as well. Would like to see this above 10%, however, which is what PayPal was averaging prior to the pandemic. And you can see now, guys, that they are focused on driving profitable growth. So the revenue expansion is fairly modest here at under 10%. Pretty much on a year-over-year basis when you take each quarter individually. Transaction margin. Now, here's something that I've been talking about, guys. Today's earnings was going to be all about the margins, and you can see how their margins have basically remained flat. So 0% improvement on the margins in this quarter in relation to Q4 of 2022. That is not the best. You want to see them start to increasing their margins as they continue to scale revenue. If the margins remain the same while they're just growing revenue, well, unfortunately, that signifies that the operating leverage at the company is relatively low. Now, non-GAAP operating income and margin. Now, we do have a little bit of, expansion here over the past quarter. But as you can see, once again, guys, the operating margin staying relatively flat. And that has been one of my gripes with the company so far. I like the company because of the valuation. If they can turn around this margin story by doing cost-cutting measures such as they have been, and also improving efficiency of how they run their business in terms of enabling faster checkout measures and potentially monetizing some of their data, that should prove helpful to driving more money to the bottom line here. Now, they did have similar active accounts here. So for the active accounts, year-over-year growth, a decline of about 2%. They just went through all of the active accounts pretty much and just kind of removed the ones that were kind of unengaged. So active accounts, not that much, but they do still have 426 million active accounts, which is very, very massive for the company, right? And you do see a little bit of a drop here in monthly active accounts in terms of your total accounts that are processing payments on a monthly basis. And as a whole, as we've shown, the number of payment transactions has actually went up on a year-over-year basis. So even though your members have been the same, the members have been using the platform more actively, which is a metric that you do want to see. That's a very positive metric as a whole. Now, let's take a look as well. I'm going to show you guys here a couple more slides that I wanted to show. Now, one thing about PayPal, guys, is the free cash flow, okay? So keep in mind, PayPal has been having a bit of a free cash flow problem, but it's not the problem that you may think. The company does generate some decent free cash flow here. However, it has been relatively flat. So let's take a look at their total standings, where they stand in terms of a business. You'll see that on a quarter-over-quarter basis, they usually bring in about $1 billion, just either shy or north of $1 billion on average, and they don't have that much debt as a whole. But the problem with PayPal, guys, is the fact that this is your free cash flow on a yearly basis for the past 10 years. And you can see here that ever since 2018, when we really got this severe ramp up in 2018 to $4.6 billion, it's just been hovering there for the past almost 6 years at this point. And with the amount of free cash flow they brought in at the end of this year, it is roughly the same. So you'll see that their fiscal year 2023, the year that just ended here, is going to be an adjusted free cash flow of roughly $4.5 billion. Now that bar is not here yet, right? Only 2022. So it's roughly going to be the same again. So as I was saying, coming into this earnings report, need to see improved guidance on margin and free cash flow, because those are the two things, as we saw from the slides, that have been relatively flat. Yes, the revenue is going up, their total process payments are going up, but when you can't bring more of that revenue to the bottom line and generate more free cash flow, guys, it's just a sign of bad operating leverage. So they really need to get to hone down on their operating expenses, essentially, and even cut some expenses, which they have been doing. So that is pretty much the story for the free cash flow. It is good free cash flow. However, it is still relatively flat on a year-over-year basis. And that's one of the bad things that's been plaguing PayPal. And you can see for 2024, guys, it's not much better in terms of the free cash flow. They're forecasting about $5 billion in free cash flow, which, yes, is an increase, you know, from the 4.5 we just got, but it's still roughly in line with what we're getting, right? So really need to improve that free cash flow on a year-to-year basis. And if PayPal can do that, I do believe that they'll be in a much better position. Now, in terms of cash and cash, their balance sheet is very healthy, though. Balance sheet and liquidity, right? Cash equivalents and investments totaled $17.3 billion. The debt only $11.3 billion as of your quarter just ended. So have way more cash than they have debt. So the company's balance sheet is very, very solid. No problems there whatsoever. As I said, PayPal's problems, guys, is just about continued growth in margins, so net operating margins and free cash flow. That's it. And they do have decent stock buybacks here, returned $5 billion to stockholders over the course of fiscal year 2023. And here's your net margins here. They didn't provide them in the report or in their slides, so we'll just do them here together. You'll see that their net income for your Q4 pretty much ending was about 1402 divided by 8026, which is your total revenue. So they have a net margin here of roughly about 17.5% for PayPal in terms of the money they bring to the bottom line, which does represent a fairly decent quarter for them. You'll see here on a quarterly basis, usually they've been averaging anywhere between 11 to 14% in the last 4 quarters. So to see them post a 17% net margin quarter is good. It's a good sign that the business is moving in the right direction, guys. So PayPal still on the recovery story for now. I do like this stock. If we do come down, further come down here, since in the after hours, it's already back to about $58. If we do come down into the lower $50 range, guys, I may be tempted to make a bit of a more long-term leveraged gamble on them in the form of leap call options, just because 2024 should be a transition year for them. When rates come down a midpoint this year, I do believe the stock will be able to get some lift, but really to be benefiting from the best risk to reward, guys, anything under $54, $53 will just be a lot better risk reward than is currently baked into the share price right now. Now let's move on to company number 2. Company number 2 is going to be Alibaba. So Alibaba had earnings today and they dropped about 6% here, guys. So Alibaba going through its fair share of struggles, as well as it is deeply exposed to the Chinese economy, which is currently going through a little bit of a recession right now. And consumer discretionary spending in China has been quite low. So the Alibaba's revenues has been a bit affected by that as well. And they did have a few items in their balance sheets that they did write off this past quarter. So their net income for the quarter wasn't that high, but still the story of Alibaba is a company that is extremely low in terms of its valuation metrics. Their price to earnings ratio, guys, on a forward basis is about a 10, which is absolutely ridiculous. They're bringing in substantially more revenue than they were back around their IPO prices, about 6-7 times more revenue than they were bringing in back in 2015, 2016. And the share price is roughly the same. Their free cash flow yield is absolutely insane. So the company's financial metrics are very, very juicy, but just the nature of the business makes it very cyclical right now, which is why it's fallen out of love with institutional investors and retail investors alike, as the China trade has been a bit of a loom here on everybody's portfolios, right? So Alibaba going through its fair share of struggles. Let's take a look at the headlines here. They did miss 1% on EPS, not that much though, but ever so slightly miss on EPS. And then revenue came in mostly in line for the quarter. So let's take a look at exactly what happened here in terms of a more in-depth breakdown. So Alibaba shares dropped 5% after revenue miss, $25 billion boost to buyback plan. This is a very big headline, guys. They have now about $32 billion that they can potentially buy back from the stock through 2027. So if you take in consideration their current market cap, right, of about 197 billion, they have about $32 billion outstanding that they can buy back from that. That represents about a 16% of your entire market cap Alibaba can buy back from now until 2027. So that is absolutely massive, should provide a decent floor for the share price as a whole, just that buyback news alone. Now, here we go. Let's take a look at the headlines, guys. Alibaba said the 25 billion increase is added to its share repurchase program through the end of March 2027, bringing the total available under the plan to 35.3 billion. Actually, it was 35, not 32. My apologies. So 197 divided by 35. Did I do that correctly? Or 35 divided by 197 rather, right? About 17.7% of total shares outstanding they can actually buy back. Very, very good. The company said in a statement that the increased buyback shows the confidence in the outlook of our business and cash flow. And Alibaba, when we focus on this company today, guys, I will focus on the cash flow because in my opinion, it's the metric that matters the most. They bring in a ton of free cash flow and very low amount of debt as well. The company's balance sheet is very nice. Revenue missed expectations, growing just 5% year over year, logging a slowdown from the previous quarters as growth in the company's China e-commerce business and cloud computing division remained slow. Meanwhile, Alibaba's net income in the December quarter fell 69% year on year to 14 billion won. So the net income, guys, pretty much plagued by two items that they had to write off, roughly about $3.5 billion worth of write-offs. So it really brought their net profits down from about $5 billion, which is normal for Alibaba, down to about 1.5, which is really low compared to your previous quarters and previous yearly quarters as well. So that's why you got your 69% drop. We'll take a look at that later when we check on the balance sheet here. The company said this was primarily attributable to mark-to-market changes to its equity investments and to a decrease in income from operations due to impairments related to its video streaming service, Youku, and supermarket chain Sun Art. So this is just them writing down unprofitable lines of business, in other words. Now, China e-commerce cloud business is slow. Alibaba has been grappling with a difficult macroeconomic environment in China where the consumer has remained weak even after Beijing removed its COVID-era restrictions. Amid economic uncertainties, local shoppers have flocked to discounting platforms such as Alibaba rival Pinduoduo. The Taobao and Tmall business, Alibaba's China e-commerce platform, so not the ones that they export across the world, but in mainland China, brought in revenue of 121 billion Chinese yuan in the December quarter, up just 2% year over year, so a bit of sign of weakness here from the Chinese consumer. Alibaba's cloud computing business, which investors have seen as critical to the tech giant's future's growth, had sales of 28 billion yuan, a 3% year-over-year rise. So not even that great in terms of their cloud segment rise, especially when you compare that with companies like Google and Microsoft growing in double-digit territory, right? Now, comments from the new CEO. Our top priority is to reignite the growth of our core businesses, e-commerce and cloud computing. We will step up investment to improve users' core experience, to drive growth in Taobao and Tmall Group, and strengthen market leadership in the coming years. So they know they have a problem and they're currently addressing it, which is exactly what I want to see from management. Now, let's take a look here, guys, at their balance sheet and let's break it down a little bit further. So you can see here that most of everything here is in Chinese RMB. So what we're going to focus on, not so much the currency, guys, we're going to focus on the year-over-year growth. So take a look at your 3 months ended here, quarter over quarter, right? So you do have 6% growth, and the 9 months ended, at least they do have 9% growth. And we're going to focus between these two tables, 3 months and 9 months ended, and I'll show you why it's important here. So here's your income from operations. Notice that in the December 2022 quarter, it was around 35 billion RMB, and now down to about 22. That's a loss of 36% in income from operations. Now, why did it hurt them that much? Well, here's the thing, guys, right? So they eliminated a bunch of segments, but also, why does it plague the bottom line so much? I will show you right now. Too much amortization and impairment of their other lines of business. As we saw in the article, this is writing down, right? So you can see the net difference here from 2022 to now, that's 10 billion more RMB. And then you have impairment of goodwill and others, which is another up about 7 billion RMB here. So that is a major component as to why their net income is significantly lower than the quarter in 2022. Net income down 77%. But it's not that bad. It is only this quarter. If you take a look at the 9 months ended, you'll see that net income as compared to the previous period in 2022 is actually significantly higher, as in 2022, they were still stuck in a bit of pandemic era restrictions in China. So you can see a net improvement here, 62% in the 9 months ended period. Now, this net income, guys, will be going up because it's just one-time charges that have been affecting the net income for this quarter. So that's pretty much what I wanted to show you in relation to their net income, but still have to write down those unprofitable lines of business, right? So, and let's take a look at their free cash flow now. However, take a look at the free cash flow generation by Alibaba. It is absolutely insane, guys. For the 3 months ended, they generated $8 billion of free cash flow in the most recent quarter, bringing their 9-month total up to about $20 billion. This is in US dollars now, almost $20 billion in free cash flow. Alibaba usually generates, anywhere between $28 to $30 billion in free cash flow per year, which is absolutely huge. Absolutely huge. And what do they do with that $19 billion? Well, so far, they've already repurchased about $7.7 billion in share repurchases, which is extremely juicy as a whole. And now take a look. So that's their free cash flow. They are a free cash flow monster. We'll get into a few statistics after this. So another $20 billion in free cash flow. If you take a look at the free cash flow that Alibaba generates on a quarter-over-quarter basis. I don't know if you can see it down here, if they'll put it here. No, you don't. But on an annual basis, you'll see pretty much that over the past couple of years, right? 2022, 24 billion. And prior to the pandemic, they were always, high 20 billions. 2019 and 2018, they hadn't grown as much. But in their best years out of the past couple of years, really high $20 billion range. That's exactly what you want to see. Very high amount of free cash flow. When you couple that with their balance sheet that is sitting very pretty right now, take a look at this balance sheet, guys, right? So cash balance as a whole, $92 billion. $92 billion. And if you take a look at their debt, what they have owing here, it's only about, about $23 billion worth of debt. So their net cash position, they're sitting at a cool $68.5 billion of net cash. And that's the same net cash that they're going to be using for all of those share repurchases. So the balance sheet is amazing. The free cash flow generation is amazing. It's just revenue is slightly, it's not that it's inconsistent, but it has been relatively low. Revenue only growing, 5, 6, 7% per year. So that's what they do need to improve. If you take a look at the cost of revenue and operating expenses, it really hasn't changed, whether it's the 9-month or the 3-month ended quarter. So you can see, guys, their costs really haven't been going up. They've been doing a good job of managing their costs, right? So cost of revenue, still about 60%. 9 months ended, still about 60%. Sales and marketing expenses, no real increases there. As a matter of fact, they've actually come down ever so slightly. Product development expenses haven't really come up that much as well, quarter over quarter or on 9-month basis. And your G&A, right, general and administrative expenses, haven't really been coming up that much as well. So they're doing a very good job of managing their costs efficiently, still bringing a lot of money to the bottom line, and they have an insane cash position. Take a look at the free cash flow generation by Alibaba, right? This is one of the best metrics you can ever have for a company. Look at this free cash flow explosion ever since going public back here, 2012, 2013. You can see it's almost a 10x in free cash flow that they bring on a year-over-year basis. And this year should be largely the same. We should be looking at about $28, $29 billion of free cash flow. So that column should be right at the top end of these levels as well. Absolutely insane free cash flow generation. They have one of the highest free cash flow yields in the entire market right now. Take a look, Alibaba Group share as of today, right? So we're looking at the free cash flow per share. So why do we look at free cash flow, guys? It's when you buy a share of a company, how much of that share price, let's say a stock trades at $100, how much of the $100 is actually fair free cash flow to you as a shareholder? That is why free cash flow is so important. Take a look at this, guys, right? So their free cash flow per share was in the quarter ending September 23 was roughly 11.62 per share, giving them a free cash flow ratio of 6.73. If you want to look at it another way, guys, if you don't know what this number means, it's very, very easy. Let's take the 11.62 divided by their current share price after the drop right now. Oops, excuse me, I must have closed that tab. So their current share price right now is about $73 after the drop. So divide 11.62 free cash flow per share divided by dollars per share gives them a free cash flow yield per share of about 16%. So that means that 16% of the share price is free cash flow to you as a shareholder. Now, if you want to look at one of the best companies in the world, right? Take a look at MasterCard and why Alibaba is so cheap in relation to MasterCard. Take a look at MasterCard's, however, right? So MasterCard generates the same roughly amount of free cash flow per share, $11.53, right? Baba was $11.62 and MasterCard was $11.53, but MasterCard's share price is $460. So out of $460, you as an investor only get $11.53 of free cash flow per share, which is a free cash flow yield per share of only 2.5%. Not much, is it, when you compare that to what Alibaba has in terms of free cash flow? So that's why everybody feels that Alibaba is an extremely juicy opportunity. They continuously generate revenues, right? They continuously increase their revenues. They obviously continuously increase their cash flow, and they're always they do have decent net margins as a whole, right? So as long as they get through these the Chinese economy woes fairly well, this business should be coming off on the other side of things very, very, very healthily, guys. Extremely healthily, as a matter of fact. So can't wait for them to really be benefiting from the recovery story that they do deserve, in my opinion. This company is very efficiently run, as we've went through their financial statements. It's just unfortunately very cyclical business tied to the Chinese economy, and that's why the share price has been going down. But the financial metrics of the company are absolutely outstanding. So I hope I've been able to communicate that well. Now let's move on to our third company, guys. We're going to be taking a look at Disney. So Disney actually had a nice little pop in the after hours. However, I am still not convinced on the recovery story, guys. So Disney in the after hours now coming all the way up to about 105.80. So after hours pretty much putting a gain here of about, 7-8%. So very good lift on the shares. Shares had been trapped below the $100 mark for a while. I did like Disney in the lower $90 range, high $80 range for a recovery play, but I'm just not convinced, guys, that the recovery on Disney is here. If you don't remember what happened to Disney, well, obviously the pandemic had a big impact on them, right? This company was generating a ton of money and earnings per share. And you can see in terms of what happened during the pandemic, it will now take them almost 10 years, guys, right? Almost 7 years, 6-7 years to get back to the same amount of earnings per share as they had prior to the pandemic. So that's why the stock has been hit so much, and the valuation still currently isn't that cheap because the price of the stock went down. But look at the earnings per share also just plummeted, right? So even though the stock price is crushed, they have the same PE ratio as they had way back when they were expensive on a share price basis. So it's kind of crazy when you think about it that way. And the revenue as well, the revenue has been, although it has been expanding, guys, it's just their net margins have been absolutely crushed. So yes, we do have revenue expansion here, but EPS, and even the net margins, take a look at the net margins over the last couple of quarters, right? Their best quarters, Q1, Q2, 5%, but a couple of the past quarters have even been negative, -2%, 1%. So a far cry of the margins they had back in 2019, about 15, 16%. And Disney, before the pandemic, was always known to have margins anywhere between 13 and 17%. Company was very healthy, but you can see how much they've been struggling with bringing money to the bottom line. So let's take a look at exactly what happened during their earnings. Disney beats earnings estimates, hikes guidance as it slashes streaming losses. Streaming has been a big loss leader for the company as they try and scale and compete with other providers like Netflix, Apple, and Amazon. Now, what happened? They actually had a double beat. So let's show you guys the double beat on their earnings first. So they did have a double beat here. So beat on earnings and beat on revenue. Not too sure why it shows a miss here, but they did beat on revenue as well. Nice little beat here on EPS in terms of that. Now, let's take a look at the headlines here. So Disney said it's on pace to meet or exceed its goal of cutting costs by at least $7.5 billion by the end of fiscal 2024. The company said it expects fiscal 2024 earnings per share of about $4.60, which would be at least 20% higher than 2023. So EPS as I've shown you guys, it is recovering, right? It is recovering. However, it is still not what it used to be. Still not what it used to be, not even close. So just don't let these 20% headlines fool you in terms of EPS, right? But they have been doing a good job of cutting costs. Disney also announced it will take a $1.5 billion stake in Fortnite studio Epic Games and launch its flagship ESPN streaming service in fall 2025. So two pieces of news that consumers did not previously had before today. The Fortnite news is good, but it's only a portion of the business here. So we'll see how that plays in to their total holdings in about a quarter or two. Disney's direct-to-consumer unit reported a $138 million operating loss. Once again, in the quarter, including the performance at ESPN Plus, losses for all its streaming businesses narrowed to $216 million from $1.05 billion in the prior year period. So they're narrowing the losses on their streaming business, but still not bringing any money to the company. Disney Plus core subscribers even shrank by 1.3 million from prior quarter due to price increases, but the company saw a rise in average revenue per user because of those subscription cost hikes. So they increased prices, and that's why they saw more revenue, but have been losing subscribers. Far cry from Netflix earnings that we saw a couple of weeks ago, where they're massively increasing their subscriber base. Disney Plus, their streaming service, unfortunately losing subscribers. Now, Bob Iger has publicly addressed Disney's theatrical release woes as well. This is something I've been talking about, guys, right? So the couple problems that we have at Disney. Number one, their streaming business loses on a quarter-over-quarter and year-over-year basis. They lose money, so still haven't been able to make that a profitable venture. Number two, their parks and experiences are pretty much at price capacity right now. They're running out of pricing power. They've monetized most of everything they can in the parks and experiences division, and consumers are really starting to taper back on those purchases, right? There's only a certain price that people are willing to pay before they shy away and go for another experience. And there's been a few articles touching on that for Disney, that Disney's parks, their pricing power is currently limited right now. And number three, it's the fact that consumers are having a bit of franchise fatigue. So with all the sequels that have been coming out in the past 10 years for their major franchises in the names of Marvel and Star Wars, now consumers are a bit tired of all of these new releases. So that's what you call fatigue, right? Consumers are fatigued from them. And Bob Iger, the CEO, has been addressing this. He's been publicly addressing Disney's theatrical release woes and vowed to rely less on sequels and more on fresh quality films. Of course, production timelines are often in the ballpark of 18 months. So Disney's box office haul will not change until 2025 or 2026. At that point, Disney is slated to release 4 mega blockbusters, an Avatar film, 2 Star Wars features, more Star Wars, and an Avengers team-up flick. So he realizes that it's a problem, and now they're addressing the problem, so we'll see. But their cost of production, guys, compare their cost of production to a company like Netflix and what they bring in. Disney on their movies spends between $300, $400, $500 million per movie, and they're lucky to get $1 billion back in the box office, right? A company like Netflix can take more unknown actors and make an entire series, an entire show for $20, $30, $40 million and gross $100, $150 million on that. So one company like Disney spends a lot of money and only makes a 2x ROI on that money. And a company like Netflix will use a lot less capital to produce its content and have 4, 5x ROI, right? So Netflix, obviously the better bet. Now, also a note of investors that this is the second quarter that Disney is using its new financial reporting structure, which segmented the company into 3 divisions: entertainment, sports, and experiences. Entertainment contains all of Disney's streaming and media operations. Sports includes ESPN, and experiences includes the company's, you can't see it here, parks and experiences and cruise lines. So here's the thing, guys. Their divisions not all performing the same. Entertainment sector revenues fell 7%, so that's streaming. At ESPN, which is their sporting division, revenues rose to $4.84 billion. That's good. And here's the parks and experiences divisions. The Disney's experiences division saw a 7% bump in revenue to $9.13 billion. Even as the company reported lower attendance at its domestic theme parks in Florida. Most of this revenue, guys, from their experiences has come from 2 of their main parks in Asia that have just been reopened over the past couple of quarters coming out of COVID. So don't get ahead of yourselves on this. US customers still refusing to pay those extra price increases, and they're seeing lower attendance at a lot of their US venues. So just keep that in mind for Disney. A couple of the headlines from their earnings themselves, where they're on track to meet their $7.5 billion annualized savings target by fiscal 2024. fine. Based on the strength of first quarter results, as well as our expectations for the balance of the year, we expect, here's the guidance, fiscal 2024 earnings per share, excluding certain items, to increase by at least 20%, which is what we covered, to about $4.60. Further, we continue to expect free cash flow generation in fiscal 2024 to total roughly $8 billion. So good free cash flow generation by Disney. If you take a look here, guys, free cash flow has never really been an issue for them, right? They do a decent job, well, except during the pandemic. They do a good job of bringing some of that money to the bottom line here, right? You know, $1, $2, even $3 billion in some quarters. For the most part, decent amount of free cash flow, but the company has so much debt, guys. So much debt accumulated during the course of the pandemic here, still standing roughly at about $51 billion. A bit too much for the amount of free cash flow that they do bring in my humble opinion. Now, we continue to expect to reach profitability at our combined streaming businesses in the fourth quarter of 2024. We'll see about that, and are making tremendous progress in this area with the losses here improving netly, like we saw, right? Their streaming operating losses now under $300 million mark, so decent. At Experiences, we generated all-time records in revenue, operating income, and operating margin in the first quarter. We recently celebrated the well-received openings of World of Frozen at Hong Kong Disneyland Resort and Zootopia at Shanghai. Okay, perfect. In February 2024, the board of directors approved a new share repurchase program. Effective February 7th, we plan to target $3 billion in repurchases in fiscal 2024. So not that much in terms of share repurchases, guys, right? So the company's worth about $182 billion. So share repurchases of $3 billion is not really going to move the mark in that respect, right? We're talking about for the full year, so roughly 3 divided by what I say, 187, that's only about 1.5% of total stock outstanding. So I appreciate the gesture, but not enough, not as much as a company like Alibaba is doing it necessarily. The board declared a cash dividend as well, 45 cents per share, an increase of 50% versus the last dividend paid in January. So finally, the resumption of dividends via the form of Disney. So very happy for them to be recapturing their business here. And take a look at their the Disney free cash flow here, 2010 to 2023. And you'll see, guys, right, increases in cash flows through 2017 and then drop off. And so now they're projecting about $8 billion, right? Projecting about free cash flow generation of about $8 billion in 2024 ending. So you'll see $8 billion is roughly what they had back in 2017. So it appears like a nice number, but it's just because they've been struggling a lot recently. So it'd be nice to get them back to normalcy. But Disney, guys, still on a recovery story, right? They do still have a lot of different lines of business that are just underperforming the markets right now. And that is one of the main things that we need to focus on, guys, is that their lines of business are just not performing adequately. Other than their parks and experiences division, ESPN is doing okay, right? But their streaming business is really still a loss leader on the company, still not bringing them a decent amount of free cash flow as a whole, guys. And the revenues aren't up that much on a year-over-year basis either, right? Year-over-year revenue increases, really low single-digit numbers as a whole. So that's a couple main things that I did want to focus here on your Disney earnings. Don't really need to take a look at the balance sheet, guys. I've done a pretty good job of summing everything up pretty much. Their revenues, still expanding decently, under about 10% per year, but really need to recapture a lot of that EPS because they still are trading expensive in relation to their current and forward EPS. And even the free cash flow, although it's nice that it's coming back, 2024 should continue to be a recovery story for Disney. So if anything, guys, moral of the story is I'm not expecting this, right? At best, we could potentially just expect very slow recapture of share price if things continue to do well for Disney, but need to see them reduce costs on their streaming services more. Uber, it's a bit late into the video now, guys, so I'll save Uber for tomorrow pretty much, or Friday, but I really love their earnings, guys. We'll see, we'll cover them on another time, but since we're already about 37 minutes into the video, I do want to get on to our technical analysis. But Uber, looking absolutely amazing. I'll cover the earnings with you guys either tomorrow or pretty much Friday after the close. Now, let us get right into our major indexes and let's just see how everything is shaping up, right? So SPY, decent day here. We were looking at the breakout potential, right? We were saying yesterday, daily bull flag was highly likely for a break to higher highs at this point. Now that is confirmed. So your daily uptrend just simply continues at this point, right? SPY never losing the hourly trend. This whole time was just hourly tightening range. And now you can see very decent trend continuation. But guys, we are getting a little bit extended at this point, in my humble opinion. Very nice weekly trend up, but extended on the daily. We're forming a little bit of bearish divergence here on the daily as well. Things are kind of overextended. All of your major tech have reported earnings already, and when you usually come into a timing of the market, guys, where all of your major earnings are out, a lot of things have gapped up substantially. A lot of things like semiconductors have run substantially as well, and the indexes now have also been running for about 5 weeks in a row since the beginning of the year. It may just be time with that February seasonality, after all the earnings and all the gap up opens and all the overbought conditions. We may potentially be leading soon into potential sell-off territory. May just be looking for a slight little correction here. I'm talking maybe correction potentially back to the all-time highs, right? 3 to about 5% could be a decent expectation for end of February into March. But as of now, your bulls are still in control, just looking for a daily higher low, anything pretty much above 483. Just going to be looking for a daily higher low for further trend continuation until the bears finally roll this over. I will most likely be looking to enter a few short positions just to hedge very shortly, guys, potentially maybe even by the end of this week. QQQ also continuing to push to the upside here, so daily uptrend is just continuing at this point for QQQ. Any retest at this point, anything below 417, right? Anything above 417, excuse me, just looking for a daily higher low for further trend continuation. But same concept, right? Same concept. You can see the bearish divergence forming here as you have higher highs on the price, but lower highs down here on the RSI, which just means that momentum leading into new highs, momentum is slowing down, which is why we may be culminating here in a little bit of a top over the next week of trading. Now on the daily, right, as I've said, the bulls are still in full control, but if we do start losing that daily trend right there, it just will be for weekly consolidation, and I will be targeting the exact same previous all-time high zone for a pullback potentially on QQQ. That would necessarily be a pullback of maybe about 5, 6, 7% into your previous all-time high. Very healthy, right? Even a weekly pullback, anything above 395, just looking for a weekly higher low for further trend continuation later into 2024. And that would really coincide, guys, with some of our headlines, right? If end of February and March is bearish, April should be fairly bullish, because in May, most likely early May, the rate cuts will be coming. So if on the monthly time frame, guys, the markets do something like this, where February and March are just a little bit of to set a monthly higher low, then April and May should be back to your monthly uptrend. That would be very fitting in the overall chart structure, if I do say personally. Excuse me, now let's move on to XLF. XLF looking healthy, right? We were looking for the tightening range to potentially break out bull. Why? Because our weekly bulls were in full control. So as soon as we get these tightening ranges at the top end of the move, usually you are looking to get a bullish break. Now, bullish break happening right now. So if we crack our previous highs, 39.43, guys, we're going to take a look at our overhead resistance, which currently sits at about $40. And then you're looking up to your 41.63 all-time highs. Bulls remain in full control at this point, right? Any pullback, just going to be looking for a furtherance of the tightening range. If not, you're on to new 52-week highs pretty much. But daily bulls in full control of this trend at this current time. Keep an eye on your 12 EMA. 12 EMA has been a very beautiful line of defense for your bulls the entire time. So if we lose it, that needs to be notable to you. We do have a nice fallback area, 38 down to 37.5. On your weekly, bulls are in full control. Weekly leg number 2 to the upside here, guys, but fairly overbought here on the weekly. And financials, other than, late cycle bubble like 2021, pretty much, financials really don't get overbought that often, guys, right? They don't get overbought, and they don't stay overbought as often as something like QQQ does. So I will just be looking for potentially overbought conditions to potentially correct here over the next couple of weeks. But financials should be doing fairly well over 2024 once we do get those rate cuts and once it takes a bit of pressure off of your banks. As of now, bulls still remain in full control. Now moving on to healthcare. Healthcare had a very nice day here today, right? Pushing new 52-week highs once again. So healthcare still in a beautiful daily uptrend at this point. Whenever this move tops out, looking for a higher low, anything pretty much above 137.26, looking for a daily higher low for further trend continuation. Now, this whole area right here, right, 141.60, you have your 12 EMA right there. And what is this red line? This red line is pretty much your previous all-time highs. So I have a couple of fallback areas, guys. If ever we lose the daily uptrend, we do have a nice little fallback area into roughly this 142 down to about 141.50, this little area right here, right? Previous resistance. It's also your previous all-time highs from a couple of times. So on the weekly, that would just be looking for a weekly higher low for further trend continuation. Healthcare looking very good. No red flags at all. IWM Russell still battling it out with our resistance zone, guys. It just cannot get above this zone, right? So we're still looking for potentially a lower high for lower low transition here for a daily downtrend for the bears. If we can't break above this range, and you know, when the rest of the markets are flying, guys, if IWM Russell cannot break this resistance to the upside, and where we may be heading into a bit of extended consolidation end of February and March, I'm really not expecting anything massive out of IWM potentially for the next month, if I do say so myself. So best case scenario, just going to be looking for a tightening range here on the weekly for the bulls. Worst case scenario, weekly downtrend is set, means monthly consolidation just continues. At that point, I'll be looking for a fallback area. We're talking about 187 down to about 181. The midpoint of this range is going to be my personal buy territory for the Russell. But just keep that in mind, guys. Growth stocks really not in favor right now. Not until the rate decreases fully come into effect, in my opinion, will these actually start getting some true lift that's going to be able to bring them above and hold above this whole $200 area of resistance. For now, the bulls still trying to play a little bit of defense, but we are looking for a lower high, potential lower low here. And then we really need to protect these weekly lows, 187.53, to maintain this tightening range, which is your best case scenario. Well, worst case scenario, I'm just going shopping for shares. And now lastly, our Dow Jones. Dow Jones not looking that bad at all, right? So 0.4% onto almost a new all-time high for the day. So Dow Jones just continues this beautiful daily uptrend. We're going to just keep our eye, guys, on this 12 EMA on the daily, right? So the Dow Jones, even though on the daily it's not overbought, it is ever so slightly overbought on the weekly now. And Dow Jones, similar to pretty much XLF financials, it doesn't get overbought that often. When it does, it can run a bit further. But now, as I've been saying, guys, we are entering pretty much the late stage cycle for a Dow Jones rally. We're talking about, now back to back, except for 1 week, you're talking about probably about 15 weeks of consecutive upside. Now, Dow Jones has had some rallies in the past, right? But this is just a massive, substantial rally that could be due for some extended pullback. Daily bulls are in full control here, so we're still looking for still looking for a daily higher low, anything at this point above, pretty much this last low right here, 37,806. Just looking for a daily higher low for further trend continuation. Seems as though they wanted to try and attempt it today, but as long as your 4-hour 12 EMA is intact as well, no loss of the 4-hour trend, your daily bulls just stay in full control, and this weekly second leg up simply continues as well. So looking good, no red flags just yet, but I'm going to be looking out for the topping out patterns, guys, which is pretty much blow off top into potential set of a daily downtrend. That's how you know you're in for a bit of weekly consolidation, and that short trade could really have some legs there for a couple of weeks. Now let's move into big tech. So big tech here, guys. Moving on to Apple. Apple looking roughly the same as it was yesterday, right? So we're still just measuring the size of this bounce. Now the size of this bounce is actually pretty nice. You can see that we almost got above our area of about $190, almost able to close above that, but not quite, but that's okay, right? So we were looking for the size of the bounce. Now Apple putting in enough of a bounce above the 618 line, which was like 190 again, right? Putting in enough of a size of a bounce that you could just be met with a little bit of a daily uptrend reversal. The bulls will create enough space to potentially put in a daily trend reversal. But if for ever which reason we fail that and start retesting these lows, guys, need to protect the weekly lows. We're just looking for a weekly tightening range at this point, which is also translating into a bit of a monthly tightening range for Apple as Apple continues to grow into its current valuations, especially with a reduced revenue growth. They have been improving the bottom line, but that reduced revenue growth has really been hurting them. Going to take Apple, at least another year to have easier comparable sales than they currently have, right? So Apple still in the process of sideways consolidation until I really see that daily uptrend confirmed by the bulls, right? We can't really say that our weekly uptrend has started. We really need a break of 196 at that point. Then your weekly uptrend would be back. We'd be back to trending. But for now, I'm just really expecting a bit of a sideways range, maybe as the rest of the market starts consolidation as well. Now, moving on to AMD. AMD also consolidating here after its, face-ripping moves prior to earnings. So now just really sideways consolidation. The bulls need to play some defense, 162.66. If we are looking out for the lower low, guys, if we do get the lower low, then it is just continued weekly consolidation. This area still proving to be a bit resilient, right? 164 down to about 158, which is proving as good support from your previous all-time highs right here AMD, though, would not be surprised if it does just consolidate with the rest of the markets after such amazing moves by semiconductors. May just be time to take a little bit of a breather. But until we lose these lows, the bulls still looking to play defense. The best they can do is tightening range above your previous area of support, and that tightening range would just be a weekly bull flag for maybe one last leg up before potentially rolling over. Monthly is looking good as well, right? Full monthly uptrend. So if ever we do get a daily downtrend confirmed, which would mean further weekly consolidation, you're just now at this point looking for maybe monthly consolidation as well after such an explosive past 3 months for AMD. But looking good. Keep an eye, guys. 164, 158, crucial area of support the bulls need to hold. Now, Amazon looking fairly good, recovering a little bit after the last couple of days of being flat. So up 0.82%, but really nothing noteworthy on the stock, right? Still in a nice daily uptrend, still looking for your daily high or low, anything above 155, currently in a nice daily bull flag. So after such a nice earnings move and such nice guidance from Amazon, can be expecting a future continuation here, especially when you take a look at the weekly chart. Very nice momentum to the upside, slightly overbought on the weekly, but would not be surprised here, guys, if we do continue into our higher area of resistance, which would nextly be roughly the $178 mark, top end of this range that we had pretty much back in 2020, 2021. So I'll be keeping a very close eye on Amazon, but Amazon still bulls in absolute full control. Need them to really hold this daily bull flag and put in that last little leg there. If ever which reason we lose the daily uptrend and go into consolidation, just gonna be looking for a weekly higher low, anything above 145 weekly higher low. So Amazon bulls with tons of space. Oops, excuse me, guys. Now moving on to Google. So Google up 0.87% on the day. Fairly nice recovery here after their earnings. So we were looking once the bulls start the bounce, which is a recapture of your hourly time frame and continuous rise of your hourly trend, right? Looking for the size of the bounce. Now the size of the Google bounce to get the bulls back in potential daily control needs to get as high as 148.47. If you get me as high as 148.47, then put enough of a bounce that they have the space to potentially reset for a daily uptrend. They had lost the daily uptrend here when they lost the lows. Now the bears are looking for the lower high. Most likely there will be a lower high, but how high is that lower high? As of now, decent size bounce. Get me up to about 149, even more decent, sets up the space for a daily trend reversal. So I like the size of the bounce on Google as of now. And even at the lows, guys, very big area of support. If we do try to retest those lows, 141 down to 138, I'm definitely going shopping for a bit more Google. Weekly bulls still in very nice control as well. So weekly higher low is most likely set. Now we're just going to go into this daily bounce process. And if we can really set a nice daily uptrend and start feeling more of this earnings gap, I really believe that this weekly trend can continue at this point for Google and really start retesting some of your previous all-time high areas in the 150 range. Now moving on to Meta. Meta 3.27% to the upside. So Meta really having a nice recovery after 2 days of, a bit of retracement after their earnings, trying to recapture that hourly trend. So we'll see if they can recapture the hourly trend into tomorrow. If they do, that means your daily higher low is set here at 453.80 and just looking for daily higher low for further trend continuation. But guys, keep in mind, if Meta for some reason fails into the next few days, that would be daily downtrend, and then we would just be looking for weekly consolidation, anything above 340, just very healthy weekly consolidation, right? Upside target for Meta remains currently $500 of psychological resistance. I loved Meta's earnings. So the stock's performing well, just currently still consolidation after earnings here. Really tough to know where it's going to go. Keep an eye on your hourly timeframes here. If the bulls can reverse this if the bulls can recapture this into tomorrow, well, most likely you're going to get a second attempt here at your 45 all the way to up to 500. And if we fail that for some reason, well, it's just going to be maybe a daily downtrend set into a bit of weekly consolidation into the rest of February, potentially cooling off some of these weekly and daily extended levels here on the RSIs. Now let's move on to Microsoft. Microsoft performing well here today, 2.11% to the upside. So that was the worry on Microsoft. Were they going to set the daily lower low? Nope, the bulls just recapturing everything. So bulls really able to just continue this beautiful daily uptrend, right? We had a tightening range at the top end of a move and now explosion to the upside. We're going to be looking for a break of 415.27, almost there, just for full regain of confidence to the bulls, but everything looking very good. On the weekly, you see it really good right here, right? Accumulation, bull flag, breakout on the weekly pattern, and on the monthly, everything is looking very gorgeous for Microsoft here. Microsoft's valuation is getting a little bit lofty, but until the bulls lose this daily 12 EMA and set a daily downtrend, we can't say that we're in for weekly consolidation. So yes, Microsoft's overbought on the weekly. It is not yet overbought on the daily, but you know, Microsoft getting up there in my opinion. I can't really buy the stock up here. It's just a hold for me, but is it currently time to sell? Well, the higher time frames would indicate that not quite yet, but it is getting fairly up there, guys. But bulls just remain in full control at this point, right? Going to be looking for a break. And then if it does break, your new higher low is set right here, 403.11 for daily uptrend continuation. Now moving on to Netflix. Netflix still continuously retracing, right? This nice little bull flag here after their earnings. So it's been about 8-9 days of consolidation here after this substantial, 20% move almost. Completely normal. Netflix, as I've been showcasing, guys, is just dealing with this previous channel that we had back here in 2020 and 2021. So we'll see. If they continue to bull flag here near the tops, they're setting the daily downtrend currently, but I really like how little of this move the bears have been able to take back in about the last 8-9 days of trading. So daily downtrend at this point is well in motion. That just means you're in for weekly consolidation. That's what I was talking about on Meta, right? Meta exactly like this, right? Fail of the high and then lower low, daily downtrend, but so much space on the weekly, anything above 464.81, just looking for a weekly higher low for further trend continuation. Netflix becomes a buy for me. If we can get below 520 all the way down to about 500, I will be making a little play on Netflix, but so far so good. Higher time frame bulls in control, just short-term bears on the daily in control of this. So we'll see, just looking for a weekly higher low, guys. Very, very good. Now moving on to NVIDIA. NVIDIA up 3%, cracking the $700 mark today, guys. NVIDIA absolutely crazy at this point, right? So NVIDIA, very simple chart, daily uptrend simply continues. As soon as this move topped out, right? If we lose, we were talking about this yesterday. Can they maintain this hourly downtrend into today? Lasted more than 2 days? No, the bulls just came back with an absolute vengeance, buying up the stock again. So now just going to be looking for a daily higher low. Anything above 607 pretty much going to be a daily higher low for further trend continuation. On the weekly, everything looking very good on NVIDIA as well. No red flags either. Overbought on the weekly, overbought on the daily, but there's so much hype behind this stock, guys, that it can just stay overbought. Look how long NVIDIA has been in overbought conditions pretty much, over the course of 2023, has been in overbought conditions more times than not, has been in overbought on the daily now ever since the month of January. So that's really a bit of an extended move. 700 was the area of psychological resistance. We're beyond that now. Now it becomes pretty much 750 on the weekly, also approaching higher end of your levels of RSI. But until I see a significant daily downtrend pattern, we can't say that we're in for extended weekly consolidation on NVIDIA. Now moving on to Tesla. Tesla also, looking fairly decent here today, 1.38%, right? So daily downtrend on Tesla was confirmed. We were just looking, how high can we get on this bounce towards the most recent lower high, which is 196.75. So far, so good. The bulls have put in a significant bounce, almost about your 618 level. So that gives them the best chance of being able to eventually, when this move tops out, set a daily higher low and reverse the daily uptrend to the upside. We'll see if the best case is that they engulf the entire move. Then they really have almost 100% probability of at least setting one daily uptrend. So we're going to keep an eye on that, but very good that Tesla hasn't been flushing the lows, right? If they do confirm the daily uptrend, then we'll be measuring the size of the bounce on the weekly to see if we can get maybe a weekly uptrend. But Tesla's still battling of this area of confluence, 180 to 170, horizontal support, and is going to be the bottom end of your downtrending channel as well. So I really like continuously playing this stock. If I can continue to write options anywhere between 180 and 170, that's what I'll be continuing to do in the next couple of weeks. So no large form recovery here by Tesla, but just looking the bulls set up nicely with the bounce over the past couple of days. We'll see, can they convert this into a daily downtrend, or we'll just set a lower high and lower low and roll really into the big area of support down here, 175, 170. Now moving on to Palantir. Palantir, another ridiculous day today, continuing on its earnings. So since pretty much the release of earnings, right, Palantir up 42%. So congratulations to all our long-term Palantir bulls right here. Palantir now pulling up into this area that I've deemed, the box of new IPO investors. We're talking roughly between $28, and the lower end at this point is going to be roughly $21.50, right? So $21.50, you'll see that that's where the markets were kind of trying to top out before. We're now beyond that, but now we have this whole nasty range, right? All the way up to 28 that we'll have to deal with. But at least it's good that we mounted the 21.50 significantly, because now this area can be proving to be newfound support, right? So mounting above daily uptrend uptrend is clear in motion right now, right? So any pullback just going to be looking for a daily higher low for further trend continuation. 2150 should be that area of fallback once we do top out on this move. And even on the weekly, guys, right? So weekly uptrend is now reset to the bulls right here. So if we do have an extended daily downtrend formation after this move is topped out, let's say it goes to 25 psychological and then tops out, well, on the weekly, just look for the pullback here, potentially to the lower $22 area. But so far, so good. Palantir uphead resistance, guys, 25 psychological, then it's 26, 27. This whole area pretty much is going to be fairly cumbersome for Palantir to get through, but so far, so good. Once again, congratulations to all the bulls. And now lastly, PayPal, guys. So PayPal dipping after earnings. We'll see how they open tomorrow, dipping into our area of support. We were dealing with this tightening range, and I was saying, guys, that earnings is going to break it one or which way, and it seems as though, unfortunately, we've now broken it to the downside. So we'll see how we open tomorrow. Still dealing with this big area of support, 60 down to about $57. If they break 57, guys, it's a really bad sign. So let's cross our fingers that PayPal bulls are able to hold up the $57, because if we lose the $57 range, guys, the $57 price, unfortunately, that would be a loss of your most recent weekly lows right here, and that would just completely undo our beautiful weekly uptrend that we've been in pretty much since the end of October. So we're going to be keeping a very close eye on how PayPal closes for the week, whether or not they can get back up to $58, $59. That would be the best case scenario, but so far your short-term structure is a bit lost. Now we have also lost our confidence in being able to break above this downtrending trend line, so PayPal still not out of the woods. So that's pretty much everything I had for you guys today. Hope you guys enjoyed the video. If you did, consider dropping a like. Would really appreciate it. Consider subscribing to the channel as well. If you're new, we'd love to have you here. Thank you so much to almost 700 of you who have subscribed. And as always, if you have any questions, guys, feel free to leave them down below in the comments. I'll see you guys after the close tomorrow. Take care and peace.